Good afternoon, everybody. Very good to speak with you today. My name is David Kelnar. I'm a partner and head of research at MMC Ventures. We're a research-led venture capital firm based in London. AI is a core area of focus for us as a firm. We've invested in about 14 AI companies over the last couple of years, representing about 75% of our capital. So this is an area we're very excited about. And we actually just recently released our State of AI report for this year. It includes some unique analysis of nearly 2,000 AI startups across Europe. Check it out at mmcventures.com. Today, though, we are discussing the challenges of scaling AI companies, how to go from nothing to rising star to exit. And the question is a really pressing one. Just 2 years ago, only 1 in 20 AI companies in Europe had progressed through from seed and angel stage through to a more mature stage of its growth. But today, 1 in 6 AI software companies in Europe is at this growth stage. But what are the challenges for scaling an AI company? And how do those challenges differ at different stages of their journey? We've got some genuinely incredible panelists today. I'm very excited. We've got some of the founders of the UK's leading technology companies, accelerators, and venture capital firms. And they have a perspective that spans from the pre-seed stage all the way through to exit. And they're here to share their thoughts with us today regarding the challenges of scaling an AI company. Could I start perhaps just by asking folks to introduce themselves and tell us a bit about your organisations and perhaps give us a flavour of the experience you have that you're bringing to this conversation. Alice, should we start with you?
Sure. Hi everyone, I'm Alice Bentinck and I'm one of the co-founders of Entrepreneur First. At Entrepreneur First, we are a little bit like an accelerator, but we actually call ourselves a talent investor. And that's because we invest in individuals before they have a team and before they have an idea. We basically invest before they're a founder. The kind of people that we invest in are usually technologists. So about 75% of the people that we invest in, and we invest in about 800 people a year, have a background in technology. And what we've seen, particularly over the last kind of 6 or 7 years, is that the majority of those people have a background in artificial intelligence. So we've built about 200 companies over the last 8 years in Europe and in Asia, and about 75% of those companies use some form of AI. We've also had a couple of AI exits. So we had Magic Pony Technology, which was acquired by Twitter, and we also had Bloomsbury AI, which was acquired by Facebook. So I suppose the world that I occupy is very much in the talent space and helping very talented individuals build the next generation of AI companies.
Fantastic, thank you.
All right. Okay, that was great. This is Gary Gabriel. So now I have a tech fund, but prior to that, I built 3 successful entrepreneurial ventures and exits. The first one was in '95. It was the second fastest growing companies in the US. The last one, 8 years back, was all in the AI, machine learning, and big data. And now pretty much all the 3 companies I built, I never raised a penny. Bootstrapped, self-funded, and exited them. Now we are trying to take that entrepreneurial spirit in this new VC model called the CXO fund, where the underlying technologies need to be AI, machine learning, and blockchain. And 90% plus of the investors are actual CXOs of Fortune 500 companies in individual capacities that range from CEOs, CFOs, CIOs, CTOs, chief data officers, chief analytics officers, you name it. Any of the Fortune 500 company knows most of them are investors in the fund. So we are one of the major investors in Cognition X. So we're excited to be part of the Cognition X journey, and we'll share more how we are trying to disrupt this marketplace.
Hi, good afternoon. I'm Dharmash Mistry. I'm a CEO turned to the dark side about 10 years ago as a venture capitalist. I'm a partner at Lakestar. We do Series A to growth, so check sizes from $5 million to $40 million. We're split across Europe. We have about 80 portfolio companies. And in this particular area, I guess, many of our larger companies, on one hand, use AI to improve their proposition. So it could be Spotify or it could be Revolut. And on the other hand, there are AI-first companies which are primarily focused. So we invest in things like 5AI in autonomous cars or Engineer AI in automating software, etc.
Hi, I'm Mike Lynch. I started life as an academic in machine learning and then went on to do a series of software companies and a number of companies from zero to over 1 billion exits. And these days I work in Invoke Capital, and we are an investor in fundamental technology. AI investments include founding investors in things like Darktrace and cyber, Sophia Genetics in genetic screening using machine learning, Luminance in handling of documents and contracts using AI. And one of my other roles has been as an advisor to the UK government and number 10 on policy changes to help AI.
Fantastic, thank you all. So let me start with a general question. In what ways, if at all, do the challenges of scaling an AI company differ from the challenges of scaling any other software business? Who'd like to start us off?
Well, if we're talking about a very early stage, it's a slightly different landscape because AI is so hot at the moment. You're getting a lot of money going into very early stage companies, and in some ways it's the transition. It's a bit like sort of rolling down a runway and taking off. So you can raise money at the moment for something which is a great demo. But the thing about anything that is machine learning based is the issue is not whether it works on a demo, whether it works in the real world. You know, when I was talking to students, I used to say the issue of machine learning is not what can it do, it's what can't it do, because that will set the actual usefulness. So one of the biggest transitions you see is people raising money. Can they actually get the thing to a point where the demo can actually move into the real world and handle all of the exceptions and things like that? And that is probably the key transition at the beginning of scaling that you don't get in a lot of other sectors, because normally if you're writing a software product, once you start writing it, you know, you can make it work. What we're going to see, for example, in the scaling of the AI companies from this very bottom end is a lot of companies will fail because at the moment there's so much money around that they can get the money, but they don't make the transition to it actually working in the real world. And one of the things you learn when you're as old as we are, David's been doing this a long time, is that winter always follows summer, and there'll be a point where funding gets a lot harder. And so the crucial thing, I think, for scaling AI at that beginning point is to get to the point where you can show something that really works in the real world, on a real road or with a real customer. And then you've got the feedback data issue. If you can get something working in the real world, you'll generate data, and data is the fuel for machine learning. And so I do think it is a bit different to other businesses.
So maybe I can grab the ball out here. The fundamentals of scaling the company don't change, right? It's at the end of the day, you're building a team. It's about building the right team. But in the world of AI, obviously you got to figure out which is the business problem you're going after. And that's super critical because AI is not for everything today. And once you figure out what those business problems are, you got to really zero in the earlier co-innovation customers. Super important because no matter, whatever your vision is going to evolve. So I'm a firm believer of the Darwin's theory. You got to adapt, evolve, and thrive. And whatever your end state is going to keep moving till you get stabilized in the information from the customers. Equally important becomes who's your strategic partner. In scaling a company, right, direct sales, the cost of sales can be a killer. And so figuring out the right partner who has the brand and can take your solution to the market is a big win. So earlier on, identifying those aspects become critical. And as part of the CXO fund I was sharing, right, you have 100 plus CXOs in the fund, and they're able to help our portfolio companies end to end and help them go scale. But then it boils down to the basic fundamentals. Do you have the right team? Okay. At the end of the day, as I built 3 companies, learned a lot, things which you don't get taught in the business schools, right? Number one thing for you to be successful is to really understand the human psychology. And how do you that into, as you're building the team, how you're interacting with your peers, your founders, and people you're hiring. All those elements weave into how you can accelerate and get things going.
I think just adding to that, look, once you get beyond a product market fit, all the normal rules apply, scaling go-to-market, scaling organizations, et cetera, all the stuff we can talk about with many other companies. I think the point that Mike makes is the one that we find the most significant in specifically AI, which is the transition between R&D and product. And there are two vectors here. There's one which is all around, being facetious. A great team could get a problem solved to 60% in a few weeks, but to get to 95% accuracy might take 5 years. And the complexity is very high, and there's quite a leap of faith. So you're backing fundamental talent. So the bar for talent, compared to investing in the last 10 years, the bar for talent is significantly higher. And we're looking for a certain set of superstar talent who can solve these specific problems. In the first wave, historically, venture capitalists backed a McKinsey guy or a Goldman Sachs guy. Now we're looking for PhDs and professors in specific verticals. And I think secondarily, this kind of transition from, R&D to product will likely mean that many teams will have to think very hard around how do they evolve that curve to even part productize en route to some big vision. And therefore, many investments which are quasi-moonshot investments, be it driverless cars or others, I think will now be step-based as opposed to purely, I can raise $1 billion and do the next piece.
I think for very early stage companies, one of the real issues that we see that is pertinent to AI companies is that the risk of exit is very high, and the risk of exiting very early is very high. Now, you can see that as a good thing, that actually you are able to throw a company together, throw a couple of PhDs together, and within a couple of months sometimes, you can sell that for a couple of million. Now, that is one way of thinking about AI companies, but I think the real risk for particularly European-based AI companies is that they exit too early. We've had some very early AI exits, and I think when you hear some of the problems that the panel is talking about, building an AI company is hard. Building any company is hard. And then building a company that is really, really hard anyway, and have somebody knock on the door saying, you can stop everything now, and I'll give you millions of pounds, millions of dollars to stop right now. It's very, very tempting. And I think one of the biggest challenges for AI companies is to say, okay, well, how do we make sure that we build the next Google or the next company that can challenge DeepMind, that can challenge Facebook research? But to do that, we need to change the culture around exits. We need to make sure that the capital that is going into AI companies has a very long-term perspective and is happy to bet something that is risky, that maybe doesn't have a clear business model, that maybe doesn't have a clear customer for potentially a couple of years, and really push them to get to the point where they can be a globally important company rather than a quick acqui-hire.
Can I add one more thing? So one of the big things, I know Mike touched on it, data. I think, first thing you got to figure out what that business problem you're going after. And if you can seriously figure out your early co-innovation customer, they'll solve 90% of your problems because you're dealing with the real business problem. And then figuring out, okay, how do I enrich the data set, the quality of the data? You're looking at 80% of the data is unstructured. So you got to pay a strong attention to the data. And then some of the other elements I mentioned, right? Figuring out the right partners, that'll help you scale.
Folks, this is fascinating. So let me summarize so far. So some of the factors that do seem to be a little bit different are the challenge of kind of moving from lab to live, making sure you're solving a real problem and the right problem in the first place, the data problem, talent dynamics, and potentially exiting too early are all some of the dynamics you're seeing in the market. Could I ask you to dig into some of those themes? Perhaps if we start on the talent side, just for context, again, the kind of research that we've done shows that there's still more than 2 roles available for every AI practitioner. It seems like the war for talent remains real. Is it showing any signs of abating from your perspectives?
So happy to talk about that a little bit. So we bring about 200 people in London each year together, and about 60, 70 of those people will have a PhD in a computer science related subject. So we are part of that war for talent. What's nice is that we aren't offering them a job, we're offering them the opportunity to be an entrepreneur and a founder, so it makes our job a lot easier. But for our portfolio companies, we do see them struggle to hire. What we do find, though, is that the companies that are taking on the most challenging technical problems seem to have the easiest job at hiring. Now, sometimes for those companies, they have the most difficult job of raising money because what they're doing is more moonshotty. But actually, they are the companies that are able to attract the best people out of labs and out of academia. I mean, one of the things that we've seen work really well is when you have deeply technical founders who do remain very closely linked to their university and are able to use their professors and other academics to help build up their team, either through giving their former professors advisory positions in their startups. But I think people often underestimate or forget how brilliant the universities are in the UK and how London is surrounded by this cluster of amazing universities, whether it's Oxford, Cambridge, Imperial, UCL, and that if you can really tap into those university networks and build relationships with the universities, you can get an unfair access to talent.
I think one of the things to bear in mind is that these problems are still very, very difficult. It's not a commodity yet. And what that means is that the quality of the talent is everything. If you get someone who's really good, they can solve a problem that someone who's more mediocre can't. And what that means in turn is that actually these days, if you're talking about something where the AI is the differentiator in the company, that person probably has to be one of the founders. They have to be really tied in. They have to have equity. Businesses come to us where they spot a problem and they say, we're going to hire a machine learning team. Well, it's just not going to happen because the kind of people that you go down to the UCL class on machine learning, you ask them at the end of a lecture, what are you guys doing? And they're all starting companies. So the idea that you can hire in as a commodity this kind of talent, if your company's based on it, it's not there yet, it will come. So what you have to do is look at different ways of getting those people attracted to the business. And obviously you have things like being much more prepared to give equity and an actual ownership in the business. And then other models where sometimes the talent wants to do engineering. It doesn't want to actually create a business. And there you can have models where you allow that company with them in it to sort of stay separate and license it into the companies that do the marketing and the selling. But you've got to be much more creative because the talent for this stuff at the moment is still the differentiator. And so the idea that we're going to employ this. Now, the universities are training more of these people. It is becoming more possible to do some of these things with less very specific, very high-end knowledge. But I think at the moment it is still the differentiator. And if you find one of these people and they're awesome, the way I look at it is I don't mind how different they are, difficult they are. Some of them are prima donnas, some of them aren't. That's the asset, and you look after them and you make sure that they have a sort of interest in whatever it is that they want, whether it is to work on an interesting problem or own some of the company, which means they're central to what you're doing. And one of the things that I see here is I went and I was doing a talk to the MBA class at Cambridge, and they all come up at the end to pitch their idea. And you have 5 people who look exactly like each other. And you say to them, well, where's the one that actually has the AI knowledge? And of course, the engineering department at Cambridge is literally 200 yards down the road, but they don't go and meet those people. And so one of the crucial things, which I think is Alice's point, you have to make the effort to go into different worlds to meet the people and create a team which is about using people with very different skills and very different interests, rather than actually having 5 people that look like copies of each other.
Mike, I said, just let's train the robots, right? Our life will be easier, huh? I said, just train the robots, right? So obviously there's a company we have invested in, which is making recruiting much easier. They're using AI machine learning. So you put down in the platform, I need to hire a CTO. And okay, Lucas Budman is the best technologist I know. And say UK, London. And it's going to spit out 10 names which are like Lucas. And then this pretty much cuts down your cost and the time to hire by 85% plus. So there are technologies which you can use today to help you in the recruitment. But again, in the early stages, and you got to have the right set of people, quality versus quantity. And then our philosophy is hire the kids who are graduating and train them the way, weave your DNA into them and build a strong team. That's what I would do.
Look, I think this is, as the guys here have said, this is a very different wave, and you need superstar talent for complex problems, unfortunately, which is finite. And so, people like us are spending more time at universities with PhDs, postdocs, professors. And I think in this model, on the one hand, the cost of talent with the likes of Facebook, Google, and others is spiraling. And therefore, the scale of the problem and the quality of people they work with is the key differentiator in terms of building the next stage companies. And we believe there's going to be a snowball effect of there are very few companies which are backable with large capital, which can get superstar talent, which snowballs and attracts more superstar talent to solve complex problems, which is completely different to the earlier waves.
Just on that, I mean, what are the kind of second-order implications of this then? If you combine the longer journey to monetization that's perhaps implied by the difficulty of developing machine learning solutions, that difficulty of kind of moving from lab to live, you combine that with the intrinsically higher cost of ML talent, that does imply that the capital requirements for AI companies can be bigger. And, again, we've seen from the data we crunched that AI companies are raising between about 15 and 50% more capital. What are the implications of that? And is that getting things bent out of shape?
So I think, if I'm really honest, I think this is potentially quite scary, and the ecosystem is working it out. Because if you take a step back, historically, pre this wave, innovation was funded by governments and often military applications. And as we move forward, most of the R&D budgets in the world exist and reside at Google, Facebook, Tencent, Baidu, etc. And the R&D budgets of these companies are bigger than the R&D budgets of countries. And therefore, most of the fundamental research, kind of moonshotty type, longer timescale, is being invested very smartly by 10 to 15 companies around the globe, generally in the US or China. So from a European perspective, we need to think about how do we play in this market, because the reality is also, if you're investing in certain markets which take longer with superstar talent, in the US you can raise $1 billion to do an autonomous car company. You can do the same in China. You can't do that in Europe at the moment. And therefore, I think this is going to be a key kind of factor in how Europe plays in this next wave, because not everything's going to run to product very quickly. And the traditional venture capital model is not suited to be waiting 4 or 5 years from R&D through a generation before it gets to a product. And the scale of the talent and the salaries of the talent to do this is complex. And for me, this is where the key role of government in Europe is critical. And I think plugging this equity gap is a requirement for the government, be it through the British Business Bank, where I'm a board member at the moment, or BPI in France, or EIF and other equivalents, to actually take that burden to help long-term strategic plays, because some of these strategic plays will end up being the key levers of your country in healthcare, in transport, in education.
Just to build on that point, which I strongly agree with, I think one of the real benefits of being in Europe and building an AI company in Europe is the cost of talent and the cost of AI talent. Our universities in the UK and in Europe are exceptional. They are world class. We're producing some of the world's best AI talent, and their price on hiring them, if you hire them in the UK, is so significantly lower than if you hire somebody to do the same job in Silicon Valley. And we're talking 10x lower. And it's not just about price, it's also about stickiness. So one of the challenges that you hear about in the Valley is that if you can get your engineers in, if you can get that machine learning talent in, you can't necessarily keep it. And that turnover, that churn can be very damaging to your business in other ways. Whereas what we see in Europe is the talent is still cheaper, more cost effective, better value, but they're also sticking around for longer. And I think this is really one of Europe's advantages that we should be trying to milk for as long as it lasts.
Yeah, one of the big advantages is doing the R&D in Europe. The trick I've used all through my career, and you get more loyal people that will be there for longer. Works very well. Coming back to the funding problem, there is an issue about this scale-up funding, but you have to realise the scale here. If you take a dark trace now will do around 100 million. Well, no government-backed initiative of itself can put that firepower into the market. It could do perhaps 2 or 3 of those kind of deals in this sector. So what you've actually got to have is government policy, which is about making sure that the large pools of private capital are actually there. And one of the big problems we have in terms of scaling up these kind of businesses is that the VC structure, which has been traditionally very defined, you're a growth investor, you tend to do Series A or whatever, means that when you see this great return, the VCs quite rationally, because it's what they told their investors they were going to do, sell out. And I think what we're starting to see in Europe is a new model of investors that will go across the whole spectrum right from seed through startup and just keep going. And I think that's a big advantage if we can get that working, because these companies shouldn't list too early, because they're very exposed to market sentiment. While AI is hot, they'll be incredibly highly valued. And then you get the situation where you're trying to build a real long-term company, and then the market goes the other way, and you get a very negative effect on the company. So these companies being able to stay private longer by using these larger private capital pools is really important if you want to build, if you want to build a 5, 10, 15, $20 billion market cap business. You really want to be able to stay private as long as possible, because it means that you can actually avoid this volatility, but also do what the business needs without the issues about actually having to do stuff quarterly. So I think there are some structural issues that need to be addressed in Europe. I think they are getting addressed, but it can't be, it's about government leveraging the large amounts of private capital rather than trying to fund stuff itself.
Could we explore those latter dynamics around kind of exiting and scaling up and exiting a little bit more? In particular, what dynamics are you seeing more around the exit side? So we've seen, I saw a stat a couple of days ago that stuck in my mind, the volume of IPOs has halved over the last 20 years, but obviously the frequency and size of acquisitions by global technology vendors has clearly increased. We've seen that in the last few days. Is it getting easier or harder overall to exit successfully, and is the shape of that probable exit in terms of acquire or stage changing, do you think?
So look, I think it's kind of, you have to kind of look across the spectrum. So as Alice pointed out, there was a lot of exits kind of very early on, especially in this wave where it might take a lot longer to get to a product market fit. People find it difficult to raise capital, but there's super talent which can be bought. And also, corporates are finding it difficult to recruit this type of talent. So the acqui-hire model in this area is quite prevalent. I think when you get to the kind of more kind of, once you get past product market fit, you're uniquely solving a problem, it's differentiated, it's defensible, it's a great company, then I think there are different dynamics at play, because I think the exit markets are even broader. Because we're seeing not just the capital markets in terms of IPO, we're seeing corporates, and historically it used to be the same corporates, the tech companies that bought everyone. Now we're seeing the FMCG companies, the banks, the others who are opening up. So there is a wide range of potential buyers for a high quality company with the right strategic fit. And in the last few years, we're beginning to see private equity come into this market, which creates another kind of exit. But it doesn't stop the fundamental of you have to be a great company doing the things that I've described for exits to happen. So people don't build companies for exits. People build companies to solve a problem or for a mission or to do something outstanding. And if they do achieve it, then the options are open. But I think the flip side of this is, we've seen, there's a benefit to staying private for longer, as Mike articulated, in this kind of wave. However, there is a kind of counter argument, because staying private for longer means that some of these companies may not have the same kind of discipline and governance as a public company would. So there's swings and roundabouts on both sides. And we've all witnessed the IPO of Lyft and Uber and a change of view in terms of pricing in the market, etc. So there are kind of many factors in play. But my overall summary would be, for great companies, the exit environment is as good as ever. The issue is there aren't as many great companies.
I think you articulated it well, but again, our philosophy is if you are really focused on the business problems and you figure out earlier on who are the right strategic partners and get that dating process started very earlier on and continue to do what you're doing. Exits will happen, but don't focus on the exit. Focus on building a great company. and good things will happen. And I would say over the last 12 months, if you look at a lot of the Fortune 500 companies and also a lot of the big software players, right, there's a big push towards how do they transform themselves. And so that appetite is increasing significantly, and they also know it's going to take them much longer to build what's out there in the market. It's really figuring out who the right players are and starting the dating process, and exits will happen.
So I suppose just a little bit from our EF experience. So we had this company, Magic Pony, that exited after 18 months to Twitter for $150 million. And that was actually a customer conversation that started off Twitter talking about buying the product and then ended up Twitter buying the company. And I think at that time, that probably was the right time for Magic Pony to exit, largely because of the kind of technology that they were working on, which was video processing. I think one of the things that I would love to see, I don't know how many people here are based in corporates or come from corporate backgrounds, but I think when we look at who does the acquiring, it's typically tech companies acquiring tech companies. I think we're moving into an age now where every company is a tech company. And actually, if you aren't a traditional tech company, it's very, very hard to hire in the kind of talent. You know, when Mike was talking about this, the real 1% of talent who are absolutely exceptional, it's really, really hard for you to hire that if you don't have a pre-existing exceptional technical team. But one of the ways you can access that talent is through acquisitions. And I think that there is probably whether it's for good or for bad, there's still probably a lot of acquiring that could be done for poorly performing AI companies that have amazing, amazing talent, but may not have got to product market fit, but that could actually end up kind of boosting a non-tech corporate's technical capabilities.
Grant. Folks, we've got just under 2 minutes left. Could I finish with a quick fire round? Just 1 or 2 word answers, please, each. Just five or six questions. What's the greatest challenge when scaling an AI company?
Access to talent.
I will say the talent and making sure you have the right data set.
Talent. Making the technology actually work in the real world.
Is it getting easier or harder or no change in scaling an AI company?
So I go back to, right, the fundamentals of building a company has not changed. So you got to focus on those fundamentals.
In some ways, it's getting easier because I think there are more investors that are open to investing in fundamental technology. But in some ways, it's getting harder because those investors are now wise enough to say, this is bullshit.
It's easier to get money at the very beginning. Then it's much harder to get past the next stage. But if you get it right, then it's whoosh.
Harder to make it.
Is Brexit having a meaningful impact in the market? Is Brexit having a meaningful impact in the market?
Whilst it's annoying all of us, but I think fundamentally at the market level at the moment, it's not.
So in the US, it's more the tweeting, which is making challenges for us.
Today, no, but I'm very worried about anything that puts off the world's best talent from coming to study in the UK.
Yeah, it's a talent. You want the talent to want to come here, and the danger of the whole Brexit debate is that we're not projecting a welcoming image.
And finally, what's the biggest difference an investor can make to support that scale-up and exit journey?
I would say the biggest difference, right, helping them for an early startup with the co-innovation customers, helping them create a strategic advisory board, and really helping them through till the product is launched and the early co-innovation customers are good to go.
Be patient and give them more money.
Let the people work on the magic, and an investor can come in and deal with the headaches of getting them someone who can write the manuals and make sure the customer service desk works. So unlike a normal business, you really want the key drivers of this business totally focused on the magic.
Often the answer is just keep out the way.
You know, one more thing, right, for entrepreneurs out here, don't take no for an answer. Have a can-do attitude. Everything is doable. Just keep believing in yourself. And dream big.
Fantastic. On that, we're out of time. Enormous thanks to my panel. I learned a lot in that. Alice, Gary, Dharmash, my huge thanks.
Thank you.